Hey, welcome in, everybody. Today, we're going to talk about the geopolitical oil time bomb. And no, not an explosion or anything like that. Why Canada, Venezuela, Russia are going to define crude prices through 2040. Okay, why and what we're going to cover today. We're going to talk about the shale boom that kept oil cheap for a decade. That's over. That tide is shifting. Oil prices are going to be geopolitical again. They've always been a little bit geopolitical. They're going to be that way again. And three countries are going to decide whether $60 crude or 120. And no, it's not Saudi Arabia. And no, it's not the US. Canada, Venezuela, Russia are sitting at the center. If you're still analyzing like oil markets like in the past, you're already behind. It is moving fast, and we're going to show you the next oil cycle.
No matter how many times you save the world, it always manages to get back in jeopardy again. I mean,
I love that quote.
I hate it when that happens. Boy, I tell you what, as many times as we've saved the world, Brian, it still comes back to jeopardy.
It does.
But let's do it one more time.
Yeah, let's go ahead and do it. So let's break it down and talk about each piece. The shale boom is over. The shale revolution that changed oil markets. And for those that don't understand shale, it's basically capturing oil from tightly condensed rock. Geologists knew oil was in there, but there was not a technology or a way to extract it. Well, in the frac and horizontal drilling boom, the Permian exploded. The Permian is one of the most prolific fields in the world, not just in the US. And in December 2025, yeah, that's just a month and a few days ago, the Permian was producing over almost 7 million barrels a day. That's more than some countries. Okay. That is
Absolutely.
more oil production than Saudi Arabia is at 10 million barrels a day. So when you look at that, it's a watershed moment. But I'm going to show you something inside. Oh, go ahead.
The Permian is producing as much as Canada. That ought to be telling you something.
Absolutely. So this is a clip of how much oil production is added in the United States, and you can see this is generally trending down. So we're not going to cover that today, but the shale boom is over and capital discipline has taken over. And these three regions are going to dictate supply. Canada is steady, reliable, but it's constrained by policy and pipeline/infrastructure. And I say pipelines because where the crude is produced and getting it out of the country is a different thing. The easy button for Canada is to drop it down into the US, send it through US refineries. However, with some of the friction between Canada and US, they might be looking at other strategies.
Also, Canada exports most of the crude oil.
Yes.
And so they don't have a local demand to use the amount of crude oil they have. So it's got to go somewhere to be sold.
Right.
The easy button has always been the United States because it was easy to get pipelines down there. But right now the pipelines are pretty much maxed out and they have a lot of trouble getting new pipelines built. And that is the issue with the policy and the pipeline limits. It's what's caused the pipeline limits. The recent feud and ongoing feud between the U.S. and Canada over this thing is leading Canada to build pipelines west to where they can take it offshore and export it out of the country on water, realizing that that's a more expensive way to move it, but they can move it. So that's the biggest thing. So the easy button is the U.S., but they're looking at other ways to do it, and it's good for Canada, probably not good for the U.S., but I still think they're going to face a lot of issues within the Canadian politics. So we'll see how that goes.
Right. Well, and speaking of politics, Venezuela, Russia, we are going to have to pay attention to geopolitics from now on. I was on a podcast on oil markets, and somebody asked a political question. I said, when I grew up, I didn't want to go into politics, but I'm in energy. So here I am. So Venezuela, obviously, over the last 60 days, that's changed a little bit. The regime is still in place, but
Right.
Maduro is not there. But they have massive
Well,
reserves.
let's rephrase that. What's changed are the players.
Hmm.
Nothing about what's going on in Venezuela has changed at all.
Right,
We took out, I mean, the leader is gone, but his group's still in power, and
right,
so Venezuela's infrastructure hasn't magically improved. They haven't magically started drilling more, and nothing magically has happened as far as capital investment in the country.
right.
So, so it's it's got massive reserves, but remember those are self-reported.
Yes,
So,
take it with a grain of salt
exactly,
or a ton of salt, depending on your
yeah.
perspective.
Well,
Um,
we had U.S. country companies down there before, and so a lot of the reserves are based on what they saw at the time.
right.
And so it's not all just Venezuela, but it's just because you have oil doesn't mean you have it to sell.
Yes, yes. So Venezuela is a dot 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 to be continued. Russia is a dot 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 to be continued. They are the second largest producer in the world, facing
Right.
sanctions, decline, isolation, and degradation of infrastructure. So
Absolutely. Infrastructure is a big problem with it.
there's a lot because you get into the permafrost, you get into global warming, you get into a lot of issues with Russian crude because the reserves are there, but they are very difficult to move out. So, and with the geopolitics in Venezuela and Russia, you have to watch that. And now with US and Canada, we got to watch the geopolitics on that. So let's
Exactly.
take a look at demand. Let's pivot to this one. Bill and I love talking about this one. Between now and 2030, IEA, which is more the Western view of oil demand, and OPEC, which is out of the Middle East, have differing pardon me, differing views on what oil demand is going to do. IEA projects demand peaks at 105 million barrels a day by 2030. By some counts, we already hit that in 2025. So I think IEA has a different sense of what reality is. Now you can go down a, a different methodology of counting to where that makes sense because they may count the barrels at 102 and show slow growth. OPEC is more bullish at 110. I would say on projecting oil demand, OPEC historically, in my eyes, has been more accurate and more on the target. And yes, they have a bias because most of OPEC members are exporters, so they want the demand to be higher. However, I think OPEC's numbers are historically closer to reality. So both of them peak in 2030 and then have a slight decline. But I do want to notice by 2040, we're still above 2026 levels per
Right.
per OPEC. So that doesn't mean that means a plateau. That doesn't mean a substantial decline in oil demand. So lots of questions there, but it's very clear from 2026 to 2030, we're going to have an increase unless there's economic challenges.
Yeah. And a lot of that increase will depend on capital investment and the price of oil. Price of oil stays cheap long enough.
Right.
We won't see the capital investment,
Yep.
and we'll see that actually happen faster down in the 108. I think in 108 barrels. But remember that OPEC you have to adjust just a little bit because they include um, natural gas liquids in their numbers.
Yes. Yes, which
And
changes,
so,
and that's another one we're going to do because it's changing the complete product mix of what we're getting out of oil and is going to toggle changes between types of oil and their strength or weakness versus pricing benchmarks such as WTI and Brent. So the Permian peak that isn't a collapse, it's not a crash, but it's a plateau. And it is sustained by AI guided drilling, 4-mile laterals. These are increasing costs. This is something that a lot of people miss. Yes, there's more productivity. However, every well is a sub-tier well that's being drilled from a productivity standpoint, and they're increasing costs on the lateral. So proppant, there's increases in costs. So, and you see more capital discipline out of U.S. producers. So the days of seeing a 1 million barrel a day annual growth, those days are over. And that's what this chart can show you, is that for the for December and November, the U.S. as a whole only grew by 10 to 20,000 barrels a day. And we're not going to go into declines versus new production. That's a different rabbit hole we'll go down on another day. But it's going to result in a plateau of Permian. So I think that's where we're at.
Yeah, I think what you're going to see the next big change in crude oil, as far as on the production side, and really more on the drilling side than on the production side, will be chemicals. I think we'll see some changes in the chemicals in the fracturing that will allow them to pull more out of tier 2 wells than they were pulling out of tier 1 wells at one point.
Right. That makes sense. Okay, shale's new reality, manufacturing mode, steep decline rates. Wells lose 50 to 70% output in its first year, and it requires continuous drilling just to maintain production. Break-even costs. Go ahead.
Anytime you see the majors involved, it's turned into a manufacturing process. ExxonMobil doesn't go out and drill new wells for exploration or wildcatting. They're there to manufacture something they've already seen. They're not much into wildcatting. You see independents do the wildcatting.
Okay. This is a number that is highly disputed, and Bill's about to call me an idiot. But according to some sources, break evens in the Permian are in the $30 a barrel range. I don't buy that at all. But
so usually when you see something that low, that tells me they don't have any land costs involved.
Right.
And so there's a big argument when you talk about break even, is it marginal cost or total costs? Because when you go out and buy the lease, in some of these break even costs, that number is not in there because it's already been spent. And so they see it as not a break even production cost. It was a break even acquisition cost of the lease. But it's you still have to get that money back in order for the well to be profitable.
Yes.
So that's where I start saying, well, how much was your land? And that could be as much as $20 a barrel starting out. Now, the longer you produce, the cheaper that land cost is, because the land cost doesn't go up or down based on the amount of volume you produce. The actual margin on the well goes up and down by how much you produce by volume.
Right.
So that's the part that you always have to ask those questions and get a little bit deeper. I really think those break-even costs are closer to $50, $51 is what I think.
I think you're right. And that's $51. That's not the WTI number. That's the number at the wellhead, which that's a different debate as well.
That's another,
Yeah. So the U.S. production trajectory, there's a plateau in the late 2020s that's projected around 13 to 14 million barrels a day, which is where we're at. ConocoPhillips CEO, U.S. output will plateau by the end of this decade. I think that plateau is already starting. Now, 2026, we're kind of approaching the end of the decade. Mid-2030s, gradual decline to 12 million. I actually think it's going to happen much sooner than that, because tier 2 acreage is starting to come into play in the Permian, which is dampening economics, which means there's going to be less capital going in to drill. And the swing producer status of the United States is no longer in. There's locked in supply, and this is something that I would argue OPEC probably saw coming. Um, so implications. Here's the market power shifts. Here's the shifts. In the 2010s, rapid U.S. expansion, supply
Extremely
growth,
rapid.
yeah, incredibly rapid. U.S. shale rise, it continued to happen. It did start to plateau and then increase after 2022 into 2023. Now we're back to a plateau looking response because, quite frankly, at $60 crude, the economics aren't there to really rapidly expand. The
Right.
shale probably
You're
needs
talking
80.
you're talking WTI at 60.
Yeah, WTI at 60. I think we probably need to see WTI at 80 before we see anything substantive in the US. So,
And Brian, we need to point out on that when we say WTI at 60, we're talking about at least a 2 to 5 year strip, not a one time, not 2 months in a year when it gets above 60.
yeah,
It's got to be it because it takes that long to get your money back out of a well. It's going is anywhere from 3 to 5 years, depending on
right.
volume.
Yeah,
And so you have to be able to hedge that strip above into a profit margin for the whole 3 years, or there's no reason to drill the well.
right, right. So in the 2030s, there's going to be a renewed OPEC resurgence as far as control because most of the barrels, a significant portion of the barrels, are controlled by OPEC/OPEC plus. Whenever I refer to OPEC, I think about it in terms of OPEC plus because that's kind of the supply reach. So the steady hand, the Canadian oil sands, it's the third largest reserves globally with current 4.6 to 5 million barrels a day of current output. It's long life, decline resistant facilities that produce for decades. And the Trans Mountain Express adds 600,000 barrels a day of West Coast capacity. This is what Bill was talking about. So this is going to ease bottlenecks and put Canada in a better negotiating position with the United States.
I believe that pipeline is expandable with the right pumps to take it up to a little over 1 million barrels a day.
I could believe it. Yeah, I could believe it. Once the pipe's in the ground, then you modify the pumps and the compression and
Right.
okay. Canada's growth ceiling. So moderate gains, then plateau. The current projection is an annual 500,000 barrel a day growth every year through 2030. I actually think that may be light. Early
Yeah, I think so too.
early 2030s. A lot of this is assembled from a lot of different analyst projections. Early 2030s, peak output, then shallow decline because it is decline resistant there. Some of the headwinds: climate policies, regulatory uncertainty, uncertainty limit on mega projects because taking that pipeline to the West Coast, we're talking a massive distance. We're talking half of the continent. So um, now the heavy crude factor, U.S. dependency, 70% of the U.S. Crude imports are heavy grades. Canada supplies 60% of those heavy imports, feeding Gulf Coast refineries. That's what U.S. refineries are built for. There is competition risk. Venezuela heavy crude. If production increases in Venezuela and Guyana, that could pressure Canadian prices. The WCS discount, which is pretty steep, at
Right.
$60, you take $15 off that. That's a pretty steep discount. But it could
Right.
widen even more if we have competing barrels. And there is a strategic buffer, such as a lower, I previously would say lower geopolitical risk and a reliable U.S. ally. I would say most of those are from a historical lens. Where we are now, gosh, I don't know. Pick the day.
Well,
Uh,
I mean, there are certain things that are just physics. And one is a lot of people say, well, we're not going to support them militarily. Yes, we are, because it's in our defense. It's our interest.
yep.
U.S. will keep doing things in interest. And I know everybody hates the America first thing, but just remember, it's American first, not American only. And so what that means is we look after our own interests first, which, by the way, is all we've ever done anyway. And so we'll see that. I think the real thing with this with a strategic buffer is that there's a lot of stuff going on right now in Alberta, and how Alberta relates to the rest of its country will determine a lot how everything relates to how Canada relates to the U.S. And Alberta's upset because they're putting in more to the federal government than they're getting back by a significant margin. And so it'll change. You know, politics are politics. They're going to do whatever they do. But the bottom line is that if you're looking at Canada, you need to look at what happened is on their exports, because the exports is going to tell their story about how this thing's going to go in the future and how much money they're going to have. And so whether they're exporting to the U.S. or exporting off the West Coast, and for that matter, there's some plans even to export off the East Coast. And so you look at Canadian exports because they have more than they can burn, and it's got to go somewhere. And that money's they're very dependent on that money to run a lot of things in their government. So that's when you're wanting to know what's going on with Canadians and stuff like that. That's where you do. Venezuela is a little bit different story because Venezuela, to move its oil, it has to have naphtha. It has to have something to blend with it. You used to get it from the Russians. We're not allowing that now. It's now coming from the U.S. And so, but before that oil can actually move, it's got to have that naphtha blended with it. So there's got to be some blending going on. So if you really want to know watch how much naphtha they import to be able to move the crude oil out. To me, that's a real big deal. I don't know what's going to happen there geopolitically. And if someone tells you they know what's going to happen, yeah, they're guessing, because that's a pretty big country to be messing with, and we got a lot of other problems besides Venezuela. So Russia's going to be the one to watch the most. You watch the sanctions on that. A lot of people think Putin's unpredictable. I think he's very predictable. He said from the start out what he wants to do. It depends on how we're going to have to respond to how he does, because his goal is to grow Russia. Bottom line.
Right.
So,
Right. So Venezuela is the sleeping giant with 300 million billion barrels.
yeah,
And then their current output is 0.9 million barrels a day, or 900,000 barrels a day. At their peak, it was probably 3 to 4 million barrels a day. A lot needs to happen there, and it's going to need a lot of work. But
that's
there's
going to take. I think it's going to take a decade to get back up there.
I would tend to agree. Three potential futures, or three futures. There's a status quo. Output stagnates and falls to 600 to 700,000 barrels a day, which kind of stays in the country. They're not really exporting much. Then a gradual easing of sanctions, and that may allow for 1.7, 1.8, maybe a doubling by 2028. I think that might be aggressive, but that's plausible. And then a full revival with Western investment would take it to 2 million barrels a day plus by 2030. But this is work of a decade. It's going to take a long time to revive. So Venezuela oil market impact. This gets back to the naphtha that Bill was talking about. Venezuelan crude is extra heavy quality. It has an 8 to 10 API, which a normal WTI barrel and Brent barrel is around 40. So the lower that number is, the heavier it is, and the less the less it moves on its own. It needs something to blend with it to make it move better.
Right, the viscosity is very thick. And the
Exactly.
other thing to realize is, but that is really what our refineries in the Gulf Coast were designed for, was Venezuelan crude.
Right.
So they've had to adjust over the years. But the other thing about that lower crude is you give you some products that you want, and most of them are the bunker fuel and the asphalt.
Mm-hmm.
And those are kind of things that we need for shipping and we need for construction in the U.S. And so that's why it has a high appeal. It also puts out pretty good quantities of diesel and gasoline, but the heavies are more useful than the lights.
Yep. So this puts price pressure scenario. Get ready for sub 50 if Venezuelan barrels flood. I actually think it would just change the locations of where oil is produced. It may be produced in Venezuela in lieu of Permian. If you have Exxon involved in the Permian and you have Exxon involved in Venezuela, I think Permian investment would decrease and Venezuela would increase. So I think it's more displacement, but that's my 2 cents. So
Yeah, I think you'll be talking about Shell in Venezuela. Exxon's already said no, thank you.
yeah. So Russia is the constrained bear. I like that analogy. The second largest producer at 10 million barrels a day in 2023. Ukraine invasion triggered sanctions, but output, surprisingly, including our projections, we projected that their output would start dropping. They have actually kept that up pretty high, mainly due to Asian support, and they're pivoting a lot of these barrels over to China and over to Asian countries that don't really recognize the sanctions, which means the Asian countries are getting a sweet deal because their competitive advantage on a price perspective is there. But
So what you're saying? So what you're saying is Russia is
Your feeble skills are no match for the power of the dark side.
yeah. Yeah. But when you look at the infrastructure, when you look at the economic momentum that is needed to sustain Russian crude, there needs to be massive investments, not to the scale that Venezuela has, but pretty close, meaning there's going to have to be a significant amount of capital flowing in to really try to revive that infrastructure because it's very infrastructure heavy. It's kind of like Canadian supply needing a
right.
lot of infrastructure. Canada has access to those funds and those resources. Russia does not. So
Russia's an economic problem, not a resource problem.
that's correct. And their long-term dilemma is they have mature fields with a tech cutoff, meaning West Siberian giants are facing natural decline. Sanctions severed relationships with BP, Shell, and ExxonMobil. What that did is that took a lot of intellectual capital out of their engineering designs. And now, can they build that from within? Can they partner with China to come in? The Western companies, BP, Shell, and Exxon, they've been on the forefront of technological advances in the oil and gas extraction. So, not to say they can't replace it, but without those Western companies involved, it's going to be a very hard row.
I think
Uh,
I'm going to give you a Bill Shanahan prediction here.
what's
I
that?
don't think it's going to be Russia and China we need to be worried about on the oil and gas infrastructure. I think Russia and China align on military assets, but not necessarily on economic assets. I think you ought to be looking at Russia and India because India has the technology
Mm,
that they could do to help Russia, and they have the need for the Russian oil. So there is something there that I think in the future that's the one to watch.
yep. Well, and this is where geopolitics matter because India just signed a deal with the EU. So and the EU is not going to want to be too friendly to Russia. So this is where geopolitics come back into play because from a logical supply and demand perspective, that makes a lot of sense. That makes a
Yeah.
tremendous amount. So here's the base case, high case, and low case. High case, maybe it grows a little bit. It goes to 11.5. It grows by 10%. Base case is it stays pretty flat. It just treads water. The low case is that we decline to 8 million barrels a day, but it may decline. I think it's going to decline a lot more than that. So I think I'd probably be closer to, pardon me, the low case there. Now, what is OPEC's window? What is their window? 2030s probably reignites a dominance because they are going to have control of swing. And non-OPEC peaks in the late 2020s with US plateaus, Russian declines, and Canada's constraints. Now, if Canada's constraints and Russian declines and the US plateaus, those are independent scenarios. So price solves US plateaus, investment in infrastructure solves Canada, and infrastructure solves Russia. So you got to watch those over the next couple of years. And total non-OPEC falls from 72.7 million barrels a day in 2028 to 69.9. That does include natural gas liquids. So bear that in mind because we are going to talk about that. Most of the world's crude has shifted from heavy to light. And what that means is we have a different product mix when we come out. And that means that some products are going to hold premium. So a Venezuelan crude might be more in demand, or Canadian crude or Russian crude, because those are heavier than a US light barrel. So from the global perspective, that quality is going to matter a lot there. But because of these forecasted changes, OPEC's market share shifts from 34% closer to 40%, and that puts them in the driver's seat.
So I think all of this is also based on the fact that no one is predicting any kind of technology change. So I think that's a big sort of sleeping bear, so to speak. If we're going to keep using bears, that any change in the refining or the processing of natural gas or crude oil has a big impact on the ability of us to be able to use it and to actually create more demand.
Right.
So that'll be interesting. I promise you, if California's gas was $2 a gallon right now instead of $8 a gallon, there'd be a lot more driving going on. And that
Right.
creates more demand.
Yeah.
And so it's going to be interesting to watch.
Yep. That definitely matters. Benchmarks. I'm not going to cover this too much, but WTI versus Brent has a historical relationship, and WTI usually has a $4 to $5 discount, but that changes on the day. The US dollar impact, this is a slow moving one to watch, but oil has historically, because of the petrodollar, been priced in US dollars. It's starting to be priced in other denominations. So when we're looking at projections into 2030, it does come back to capital and dollars as well, because that's what's needed to invest in the upstream is economic capital, whether it's in US dollars, whether it's in the yuan, whether it's in another currency. There are other dynamics, and that is a very, very unique perspective to look at. So where do we go from here? Supply erosion in the US. The US and Saudi are no longer the swing supply for the next several years. So what about those three countries? Canada, projection is grows slowly. Russia declines quietly. Venezuela is all about geopolitics. That could go up or down. That's volatility, and it's only going to get more volatile. And OPEC's strategy is going to be interesting. And right now, I think their strategy has been to wait it out. And the key, stop watching headlines, start watching structure. That's what we do here at Energy Rogue. Bill and I run a company, energyrogue.com. You can read more about it for people that follow oil markets, that follow natural gas markets. diesel markets, gasoline markets, electric markets. If you want to be on top of the energy markets and not spend 40 hours a week, there's a free mastering oil and gas clarity in 5 minutes a day that you can just download. The link is below. There's also a link to our website where you can learn a little bit more about us and see if you want to become more educated, because Bill and I break this down every single week, and we have resources and tools for traders, for hedgers, for front office, back office, anybody that is impacted by the price of oil and gas commodities. So,
So we take the data. We don't just dump a bunch of data on you. We take the data, we turn it into information, and we help you not just take the information, but turn that into a strategy.
right.
And we'll do more, but you can see all that when you click down below. We're not going to do a big commercial here. Just follow your cursor.
Just follow your cursor and listen. If you have a question about these markets, if you have a comment, like if you think we're off base, let us know down below, because when you comment, we will get back to you. We may be slow because we run it pretty lean here at Energy Rogue, but we're here finding the truth. It's not about agreeing with our thesis or disagreeing. It's about finding that truth. And that's what Bill and I focus on every single day, is we really focus on finding that truth.
You know, I've always wondered about you guys.
Well, the one thing we do is that we want to make sure that we hear from you. We're not scared of you, and we're anxious to hear what you got comments on.
That's right. Well, listen, folks, thanks so much. Appreciate you dropping in. If you made it this far, really appreciate you. Thanks for your perseverance, and your support is always kindly received with a like, with a share, with a comment. All that stuff really helps. And if you want to learn a little bit more on how you can understand the oil and gas markets in 5 minutes a day, there is a link right down below. It doesn't cost you anything to get that. So listen, folks, thanks so much. And when are we going to see them?
We will see them again in another week, if not sooner.
That's right. Listen, folks, thanks so much. Enjoy your